There is a number that has been bothering me for months. Between 2014 and 2018, the 25 wealthiest Americans watched their net worth grow by $401 billion. During that same period, they paid $13.6 billion in federal income taxes. That is a combined effective tax rate of 3.4%. Not 34%. Not 24%, 3.4%. You are almost certainly paying a higher effective rate than the 25 richest people in America. This is not a conspiracy. This is not offshore accounts. This is not fraud. ProPublica obtained and analyzed actual IRS data to produce that number. The IRS knows about it. Congress knows about it. The Treasury knows about it. And none of them have changed it. Because what the ultra-wealthy are doing is entirely, completely, and explicitly legal under the Internal Revenue Code. The strategy has a name. It is called buy, borrow, die. And once you understand how it works, once you see the three mechanical steps that produce a 3.4% effective tax rate on nine-figure wealth accumulation, you are going to look at the way you handle your own investments completely differently. Because here is the part of this story that the financial media consistently buries in the last paragraph. You do not need a $100 million portfolio to use this strategy. Most securities-based lending programs require a minimum portfolio value of $100,000 to $250,000, making the borrow phase accessible to a broader range of investors than many assume. You need a portfolio. You need appreciated assets. You need to understand three rules about how the tax code treats buying, borrowing, and dying. And you need to stop doing the thing that the average American investor reflexively does, the thing the financial industry has trained you to do, which is sell. Selling is the most expensive thing you can do with an appreciated asset. And most people do it constantly, automatically, without ever calculating what it costs them. Let me show you exactly what I mean. The selling problem. Picture two investors. Call them Raymond and Victor. They are the same age, 52, and they started investing at the same time in the same index fund with the same amount of money. 20 years ago, each of them put $150,000 into a broad market index fund. That fund has grown at roughly the market's historical average. Today, each of them has a position worth approximately $820,000. Their embedded gain, $670,000. Their original cost basis, $150,000. Raymond needs $200,000. His roof needs replacing. His daughter's wedding is this year. He wants to help with the down payment on her house. He does what most Americans do. He calls his broker. He sells $200,000 worth of the fund. The tax bill arrives. Raymond held the position for more than a year, so the gain is taxed at long-term capital gains rates. His household income puts him in the 15% federal capital gains bracket. His state takes another 5%. Combined rate, 20%. His $200,000 withdrawal required selling shares with an embedded gain of approximately $163,000. Tax on that gain, roughly $32,600. Raymond needed $200,000. He sold $200,000 worth of stock. He received $200,000. He then wrote a check to the government for $32,600. His actual net proceeds from the transaction, $167,400. The remaining position after the sale, approximately $620,000. Still growing, but the $163,000 of gain he realized is gone, taxed, and will never compound again. Victor needs the same $200,000 for the same reasons. Victor does not call his broker to sell. Victor calls his brokerage's wealth lending desk. Victor has an $820,000 portfolio. He can typically borrow a significant percentage of his portfolio's value, often 50 to 70%. Victor draws $200,000 against a securities-backed line of credit, an S block, using his portfolio as collateral. First Commonwealth Federal Credit Union tax bill on the loan proceeds, 0. Loan proceeds are not income. Because loans aren't considered income, there's no immediate tax bill. The IRS does not tax money you borrow. Gayoff Math Victor's portfolio keeps growing. The full $820,000 continues to compound. Victor pays interest on the $200,000 he borrowed. Interest rates for S blocks often are lower than those you'd be able to qualify for with a personal loan or line of credit from your bank or by using a credit card. Levy I.O. Raymond paid $32,600 in taxes and permanently lost the compounding power of $163,000 in realized gains. Victor paid interest on $200,000, and his entire $820,000 portfolio kept growing. Same starting point, same portfolio value, same cash need. Completely different financial outcome, because one of them understands that selling is a taxable event and borrowing is not. The 3 steps. The buy, borrow, die strategy is exactly what its name says. 3 steps, each one building on the one before it, each one using a specific provision of the Internal Revenue Code that has been in place for decades. Step 1, buy. You acquire assets that appreciate over time. These typically include stocks, bonds, real estate, private equity, or even valuable collectibles. The key is that these assets are held for the long term, allowing their value to compound and appreciate significantly over decades. Smart asset. The critical tax principle at work in the buy phase is this. Under IRS Section 1001, a taxable event occurs only upon a realization event, such as a sale or exchange. This means an investor can hold a portfolio worth millions in unrealized gains without owing a single dollar in capital gains taxes. Squarespace. Unrealized gains are not taxed. They cannot be taxed under current law until you sell. This is the foundation that everything else rests on. The longer you hold, the larger the unrealized gain grows, and the larger the gap between what you paid and what your assets are worth becomes. That gap is the engine of the entire strategy. Step 2, borrow. When you need cash for living expenses, for a major purchase, for anything, you do not sell. You borrow against the appreciated assets using them as collateral. A securities-backed line of credit is a revolving line of credit that allows clients to borrow against the value of their taxable investment portfolio without selling any of the securities. It's secured by the assets in the account and provides flexible repayment with interest-only minimum payments. Empower. The tax principle at work in the borrow phase. Loan proceeds are not income. The IRS does not treat borrowed money as taxable. You receive $200,000 from an S-block draw. You report 0 additional taxable income. You owe 0 capital gains tax. Your portfolio keeps compounding on its full pre-borrow value. The U.S. doesn't tax money you borrow, and neglecting sales taxes, it doesn't tax money you spend. Further, it doesn't tax capital gains, the increase in value of your assets, until you realize those gains by selling assets. The interest you pay on the loan is the cost of this strategy. It is real. It must be factored into the calculation. But in most environments, the portfolio's expected long-term appreciation exceeds the borrowing cost, meaning the net effect of borrowing instead of selling is positive even after accounting for interest. The practical result? Their assets continue to grow and the borrowed funds cover spending, investing, or lifestyle expenses. This is how the 25 wealthiest Americans maintain extraordinary lifestyles while reporting relatively modest taxable income. They are not spending income. They are spending borrowed money secured by appreciated assets, and borrowed money is not income. Step 3, die. This is where the strategy closes the loop, and where the Internal Revenue Code does something that most Americans never fully appreciate. Under current U.S. tax law, when a person dies, their heirs receive a stepped-up basis on inherited assets. This means the cost basis of the assets is stepped up to the current fair market value on the date of the original owner's death. Consider what this means in practice. Consider an asset bought for $1 million that appreciated to $10 million. If the owners sold it during their lifetime, they would owe capital gains tax on the $9 million profit. However, if they hold it until death, their heirs inherit it with a new cost basis of $10 million. If the heirs then immediately sell it for $10 million, they incur virtually no capital gains tax as their profit is 0. The entire $9 million of appreciation during the deceased's lifetime effectively escapes capital gains taxation forever. The outstanding loan, all the borrowing that funded decades of lifestyle and expenses, does not disappear at death. Just like any other liability, the heirs or the estate must pay it off, typically using a portion of the estate's assets. But here is the mechanism that makes this work. Your heirs inherit the asset at a stepped-up basis, which means they can sell it the next day and pay 0 capital gains tax. The loan is paid off, and the rest goes to them tax-free. In the end, neither you nor your heirs paid capital gains tax. Griffin funding. Griffin funding. Buy, borrow, die. 3 steps. 1 continuous loop. Capital gains taxes, never realized, never paid, permanently forgiven at death through the step-up in basis. This strategy protects the inheritance of wealth, especially extreme wealth, allowing the very wealthiest families to hold, live off of, and transfer that wealth without ever paying taxes on it. And it's all legal. Lend EDU, the numbers in real life. Let me run this out over a realistic timeline so the math is concrete. Starting point, you are 55 years old. You have a taxable brokerage account worth $500,000. Your original cost basis across the portfolio is $180,000. Your embedded unrealized gain, $320,000. Traditional approach. You sell as needed over the next 30 years to fund retirement expenses, supplementing Social Security and pension income. Every time you sell, you realize gains taxed at 15% to 20% federal plus state. Over 30 years of systematic selling, you pay, conservatively, $80,000 to $120,000 in capital gains taxes on the withdrawals. Your portfolio stops compounding on every dollar you pull out. Your heirs receive whatever is left, with a stepped-up basis on the remainder. Buy, borrow, die approach. You never sell. Instead, you establish an S block against the portfolio. As the portfolio grows, your available credit line grows with it. You borrow to supplement income when needed. You pay interest, real money, real cost. But the full portfolio keeps compounding on its full value. When you die with $1.4 million in the portfolio after 30 years of growth and $350,000 in outstanding loan balance, your heirs inherit the portfolio with a stepped-up basis of $1.4 million, sell enough shares at zero capital gains tax to pay off the $350,000 loan, and retain $1.05 million, on which they owe no capital gains from your lifetime of appreciation. The $80,000 to $120,000 in capital gains taxes you would have paid in the traditional approach, never paid. The gain you would have permanently lost to taxation and removed from compounding, preserved. The estate your family receives, larger, tax-free on the historical gain, and still eligible for the step-up on any future appreciation they experience before they sell. Who can actually use this? The most common objection at this point is, this is for billionaires. This is for Elon Musk. This has nothing to do with my $300,000 brokerage account. That objection is understandable and mostly wrong. The buy and borrow strategy is not limited to billionaires, though it is most commonly associated with ultra-wealthy families. Any individual with a significant portfolio of appreciated assets, access to favorable lending terms, and a long-term wealth transfer perspective can benefit from elements of this framework. Squarespace. The minimum portfolio requirement to access an S block at most major financial institutions is $100,000 to $250,000. To qualify for an S block, firms often require that both the market value of your portfolio assets and your initial withdrawal meet certain minimum requirements. It's not uncommon for a firm to require that your assets have a market value of $100,000 or more to qualify. Levy.io. In general, securities that are eligible to serve as collateral for an S block include stocks, bonds, and mutual funds held in fully paid-for cash accounts. Levy.io. This is not a $10 million minimum product. This is a product available to anyone with a six-figure taxable brokerage account, which includes a significant portion of working Americans who have been investing consistently for years. The strategy scales. A person with $200,000 in appreciated stock applies the same three mechanical principles as a person with $200 million. Buy appreciated assets, hold them without selling, borrow against them for liquidity needs, and let the step-up in basis at death eliminate the lifetime of unrealized gains. The numbers are smaller. The tax savings are proportionally identical. The real risks, and they are real. This is not a pitch. This is an explanation of a legal strategy, and a complete explanation requires being direct about where this strategy can go wrong. Market decline risk. If the value of your securities decreases, you must still repay the loan. If the investment account is impacted by market fluctuations and the collateral value falls below the amount borrowed, it may trigger a margin call. A margin call requires you to deposit additional assets or repay part of the loan immediately. In a severe market downturn, a heavily borrowed investor may be forced to sell positions at the worst possible time. Exactly the scenario the strategy is designed to avoid in order to meet collateral requirements. Fidelity. The practical protection against this: borrow conservatively. The maximum S-block credit line is typically 50% to 70% of the portfolio's market value. Borrowing to the maximum creates significant margin call vulnerability. Borrowing at 20% to 30% of portfolio value provides substantial cushion against normal market volatility. Interest rate risk. S-blocks are typically pegged to SOFR, which has daily volatility. This can allow for your interest rate to rise rapidly in a worst-case scenario. In a rising rate environment, the cost of borrowing increases. The strategy works when the portfolio's long-term appreciation exceeds the borrowing cost. When interest rates rise significantly, that spread compresses and can turn negative in short periods. Tax policy center legislative risk. While the OBBBA preserved the stepped-up basis provision, future legislative sessions could still target this rule. Past proposals have suggested a carryover basis system or a deemed realization event at death, though none have been enacted. The step-up in basis is the capstone of this entire strategy. If Congress eliminates or significantly modifies it, the die phase of buy, borrow, die no longer erases the lifetime of unrealized gains. Congress has discussed this repeatedly. It has not happened, but it remains a legislative risk that anyone using this strategy for multi-decade planning should monitor. Squarespace. Loan repayment at death. The loans do not disappear. The estate is responsible for paying them off. If the portfolio has declined significantly in value near the time of death, or if borrowing exceeded what the portfolio can absorb, the loan payoff can consume a larger share of the estate than anticipated. Estate planning that incorporates this strategy needs to account for the loan obligation. The tax code inside the strategy. Let me name the specific code sections so this is concrete and verifiable. IRC Section 1001. Gain or loss from the sale or exchange of property is realized only when a sale or exchange occurs. Holding appreciated property, no matter how long, no matter how large the gain, does not create a taxable event. You pay capital gains tax when you sell, not before. IRC Section 61. Gross income includes all income from whatever source derived, with specific exceptions. Loan proceeds are not income. The IRS has consistently held that borrowed money, even secured by appreciated assets, does not constitute taxable income to the borrower. IRC Section 1014. The basis of property acquired from a decedent is the fair market value of the property at the date of the decedent's death. This is the step-up. It is automatic. It applies to stocks, real estate, business interests, and most other appreciated capital assets held at death. According to the Joint Committee on Taxation, the stepped-up basis provision will account for $72.5 billion in foregone revenues for the federal government in 2026. That is equal to about a quarter of all revenues from taxes on capital gains. Precision Tax Relief 3 Code Sections. 3 mechanical rules. Working together over a lifetime to produce an effective tax rate that the ProPublica analysis put at 3.4% for the 25 wealthiest Americans. The rules apply to everyone equally. The code does not say this provision is only for people with $100 million portfolios. It says, don't sell, borrow instead, and at death, the unrealized gain is forgiven. Everyone who holds appreciated assets in a taxable account is subject to the same rules. The question is whether you know about them. The interaction with estate planning. The buy, borrow, die strategy does not operate in isolation. It intersects with estate planning in ways that amplify its effectiveness and in ways that create complications if not addressed proactively. The step-up in basis at death applies to assets held in a taxable brokerage account, directly owned real estate, and most other capital assets held outside of retirement accounts. It does not apply to traditional IRA or 401k assets, which are pre-tax accounts. Those pass to heirs as ordinary income, not capital gains. This creates a natural division in estate planning strategy. Pre-tax retirement accounts, traditional IRAs, 401ks, should generally be spent or converted during your lifetime because they do not benefit from the step-up and will be taxed as ordinary income by your heirs. Taxable brokerage accounts with appreciated positions, stocks, index funds, ETFs, are the assets you want to hold until death because the step-up eliminates the lifetime of unrealized capital gains. The interaction with the widow's penalty compounds this. As discussed in prior videos, when a married couple's first spouse dies, the surviving spouse loses the married filing jointly brackets and becomes a single filer. Required minimum distributions from traditional IRAs hit the narrower single filer brackets hard, but Roth conversions made during the married years reduced the traditional IRA balance, and appreciated positions in a taxable brokerage account that the surviving spouse inherits get a full step up in basis, generating zero capital gains when sold. The buy, borrow, die strategy is most powerful when it is integrated into a comprehensive plan. Roth conversions to eliminate the traditional IRA's future ordinary income exposure, combined with systematic hold and borrow against the taxable brokerage account to generate liquidity without realizing gains, combined with proper account titling to maximize the step-up in basis at the first spouse's death. The three strategies together, Roth conversions, step-up optimization, and S-block-based liquidity, address the three primary tax traps of American retirement planning simultaneously. The practical starting point. Here is what this looks like for someone who is not a billionaire, but who has been investing consistently and has a meaningful taxable brokerage account. You are 58 years old. You have $320,000 in a taxable brokerage account, mostly index funds you have been adding to for 15 years. Your cost basis across the account is about $140,000. Your unrealized gain, $180,000. Under the traditional approach, when you retire at 65 and need to supplement Social Security and a small pension, you begin selling index fund shares annually. Every sale triggers a capital gains event. Over a 20-year retirement, you realize most of that $180,000 gain, and eventually much more as the portfolio continues growing between withdrawals. You pay capital gains tax on every withdrawal. Your estate receives whatever remains at your death with a step-up on the final balance. Under the borrow-to-die approach, you contact your brokerage's lending desk today, not at 65, now, and establish an S-block against the $320,000 portfolio. You get a credit line of roughly $160,000 to $224,000 at 50% to 70% loan-to-value. You do not use it yet. You let the portfolio grow. At 65, instead of selling shares to supplement income, you draw from the S-block. Your portfolio, now worth significantly more after 7 more years of compounding, continues growing on its full value. You pay interest, which is a real cost, but the $180,000 of embedded unrealized gain and all the gain that accumulates between now and your death is never realized, never taxed, and forgiven entirely when you die and your heirs receive the account with a stepped-up basis. The difference in your estate's after-tax value, potentially 6 figures, depending on how long you live, what the market does, and what interest rates do. The difference in your annual tax bill during retirement, potentially significant because S-block draws are not income and do not affect your marginal bracket, your Social Security inclusion rate, or your IRMA Medicare premium tier. That last point is not small. Every dollar of capital gains you realize in retirement adds to your modified adjusted gross income. That magi determines what percentage of your Social Security benefit is taxable, up to 85%. It determines which IRMA tier your Medicare Part B and Part D premiums fall into. Realizing $50,000 in capital gains in a year can push you into a higher IRMA tier, costing you an additional $600 to $900 per year in Medicare premiums for 2 years. Drawing $50,000 from an S-block costs you nothing in magi. It does not touch your Social Security inclusion. It does not trigger an IRMA penalty. The S-block draw is invisible to the IRS's income measuring systems. The capital gains sale is not. What changes at death and how to plan for it? The strategy requires estate planning to execute properly at the final step. Several elements matter. Account titling. The step-up in basis applies to assets in a taxable brokerage account owned individually or jointly. Assets held in certain irrevocable trust structures may receive different treatment. A revocable living trust, the standard estate planning vehicle for avoiding probate, generally preserves the step-up. Assets funded into an irrevocable trust during the grantor's lifetime may not. Confirm with your estate planning attorney how your specific trust structure affects the step-up. Loan documentation. If you are carrying an S-block balance at death, your estate needs clear documentation of the outstanding loan amount, the collateral, and the repayment process. The executor needs to understand that the loan is paid off using estate assets, typically by selling a portion of the portfolio at the stepped-up basis before the remainder passes to heirs. Beneficiary coordination. The stepped-up basis passes to whoever inherits the taxable account. That may be your spouse, your children, or a trust. The step-up applies to the fair market value on the date of your death. Heirs who sell immediately realize zero gain on the lifetime appreciation. Heirs who hold the inherited assets and sell years later pay capital gains only on the appreciation that occurs after they inherit. Their holding period begins fresh. In community property states, California, Texas, Arizona, Nevada, Washington, Idaho, Louisiana, New Mexico, and Wisconsin, jointly held community property typically receives a full step-up on both halves of the account when one spouse dies. In non-community property states, only the deceased spouse's share receives the step-up. Proper account structuring before death, confirmed with an estate planning attorney familiar with your state, can significantly affect how much of the step-up your surviving spouse receives. The honest summary. The buy, borrow, die strategy is legal. It is built on Internal Revenue Code sections that have been in place for decades. It is used by the wealthiest Americans not because they have access to secret rules, but because they understand the rules that apply to everyone and they build their financial lives around them. The strategy has three elements: buy and hold appreciated assets without selling, borrow against them for liquidity at rates below the cost of capital gains taxation, and hold until death when the step-up in basis forgives the lifetime of unrealized appreciation. It is not risk-free. Market declines, rising interest rates, and potential legislative changes all create real exposure that must be managed through conservative borrowing ratios, proper estate planning, and ongoing monitoring of tax law developments. It is not for everyone. People who need their assets to generate income directly, who are unwilling or unable to carry loan balances, or whose portfolios have minimal unrealized appreciation may not benefit meaningfully from the borrow phase. But for anyone with a taxable brokerage account holding appreciated positions, particularly anyone in the range of retirement planning who is thinking about how to generate cash flow without triggering massive capital gains events, understanding this strategy changes the conversation about what selling actually cost you. Raymond needed $200,000. He sold stock. He paid $32,600 to the government for the privilege of accessing his own money. Victor needed $200,000. He borrowed against his portfolio. He paid interest, a real cost, a manageable cost, and his portfolio kept growing on its full pre-borrow value. Same portfolio, same need, same tax code. Different outcomes, because one of them understood 3 sections of the Internal Revenue Code and the other one did not. The code applies to everyone equally. The question, as always, is who knows how to read it.